Families should consider canceling their subscription to Disney Plus. You really think like a $10 subscription to Disney is going to fight inflation when your mortgage is up over $1,000 a month? Today, folks, I cannot state the severity of what we're probably about to witness in the Canadian real estate market. If you live in Ontario, where I live, the average cost of home over $1 million, where you only had to come up with 5% down on the first $500,000 and 10% down on anything thereafter, meaning you could have leveraged several $100,000, and that is coming back to bite people in the ass. We're going to take a look at the recent interest rate hike. I was personally visiting the bank, and what I heard was damn near horrifying, and we're going to take a look at how these bank stocks are performing and if these are good buying opportunities for those that are dividend focused investors, with two banks right now that are yielding over damn near 6%. But let's get into this with first and foremost the news article here, guys. Let's break this down, and we're going to hear a personal story of people getting affected by these interest rate hikes as Bank of Canada raised the rate again to 4.25%, but opens the door to staying there. I think they're finally starting to get a little fearful for the damage they're causing. The move was widely expected by economists who were anticipating a rate hike of either 25 or 50 basis points. Canada's central bank has raised its rate 7 times this year in its fight to wrestle inflation into submission. In the process, the bank has taken its rate from functionally zero to its highest point since 2008 in its fastest pace of rate hikes since inflation targeting began in the 1990s. Those rate hikes have had a huge impact on the rates that Canadian consumers and businesses get from their banks on things like saving accounts and mortgages, and we're starting to see the deterioration of the quality of these loans with the recent earnings we saw to some of these banks. Canada's 5 biggest banks moved swiftly to match the bank's increase, raising their prime lending rate by the same 50 basis points. The prime lending rate at all Canada's major lenders will now be 6.45% as of Thursday morning. That will increase borrowing costs for anyone with variable rate loans. Here's kind of just a little chart exemplifying that I think we're going to start to see an intersect, because I do think inflation's dead. It's like beating a dead horse here, guys. Commodities have rolled off. Gasoline is crashing. We do not need to continue to see these record, rates of interest rate increases. But in previous rate hikes this year, the bank made it clear that it would continue to raise its trend-setting rate until inflation came back to within the range of up to 3% that it likes to see. Within some contradictive statements, even after announcing its biggest rate hike ever, a full percentage point in July, the bank was saying it continues to judge that interest rates will need to rise further. But Wednesday's statement accompanying the rate decision was clear departure from that tone, as the language shifted to a more neutral wait-in-speech approach, and a clear suggesting that the bank may be getting ready to stand on the sidelines for a while. In this statement on Wednesday, the bank is saying that it will be considering whether or not the rate has to go higher in order to bring supply and demand back into balance and return inflation to target policy. Now, the reason this is going to be so horrifying and the bank is starting to pedal back a little bit is because the deterioration of the value of bank loans, which is going to lead to higher, solvency, delinquency ratings. I was recently visiting Bank of Nova Scotia, talking with one of their business advisors, and what they mentioned really kind of gets highlighted in this article, and how this lady here specifically is just getting absolutely devastated. Let me just read through this quick. On the advice of her mortgage broker, because mortgage brokers want to keep you broke, and others, she opted for a variable rate loan. Ruined her life here. Her initial rate was 1.92%, which worked out to a mortgage payment of $1,700 a month within her family's budget. But even before Wednesday's hike, her mortgage rate skyrocketed to 5.5% and a monthly payment of $2,700. That $1,000 uptick gobbles up every spare cent the family has, and then some. My kids do not have any extracurriculars because I can't afford it, she said. Every single penny is going toward the mortgage. She bristles at the suggestions that families can beat inflation by cutting back on expenses, such as the recent quip by Federal Finance Minister Chrystia Freeland that families should consider canceling their subscription to Disney Plus. You really think like a $10 subscription to Disney is going to fight inflation when your mortgage is up over $1,000 a month? Oh my God, that's so ridiculous to even consider, mentioning that. I think that's very ignorant to the average person that's dealing with this. I already don't have one of those things this lady mentioned, and even if I had those, how would getting rid of for $30 make up $1,000 as an escalation in these interest rates? While she's glad to have a home for her children, she's angry that the bank seemed committed to raising rates and punishing families like hers, despite the bank's infamous 2020 pledge that interest rates are going to be low for a long time. I should punch myself for that decision, she says. Why did I listen to these people? Because these mortgage brokers, these real estate agents, they're not there to help you. We were in the greediest market for the last 10 years, and it's about to bite so many damn people in the ass. I mean, take a listen to this poor woman here. I mean, this is just unfortunate.
Well, for me, the biggest problem will be the interest rate increase for my mortgage, because that's going to like quadruple my my mortgage costs every month. Yeah, because I was lucky. I locked in just for 2 years at a really low rate, and then but that's up in February, and the Bank of Canada, I heard, is going to put up the rates maybe 50 basis points, which will take me from like just under 2% to like 7%, which means that everything that you pay in the month, instead of paying down a lot of it on your principal or your capital, is just going to interest. So you're just literally standing still. I know, it's very, very depressing, and yeah, I'm not young. I've had my mortgage for years.
So what's about to happen here, guys, is we're going to get through this inflection point over the next 6 months where these horrible rated loan mortgages, and as mortgages come up for renewal in the next year, the ones that are coming up for renewal, we're going to see that dramatically impact some of these banks. And I was just talking to one of the financial advisors over at Scotiabank, and they were mentioning that they are not really seeing new people come in to get mortgages. The fact is a lot of people that have those variable rates are starting to reconsider their own personal finances, and that's going to uptick the amount of delinquencies and loans that, you know, just start to default, which is really de-weighting and re-weighting a lot of the values, because, you know, there's different values of loans on their balance sheet, and it's going to be a tough market for some of these banks that aren't that diverse and are running into these issues, which we're seeing with Canadian Imperial Bank and Bank of Nova Scotia. I mean, their stocks have been pretty devastated as of recent earnings, but once we kind of get through this inflection point, I'm sad to say, but these banks are going to print. I mean, you know, you go through any time in history, through every periodic crash that's ever been experienced through these banks, and they've always come out more resilient and more strong. And it's always been proven to be a very opportune buying opportunity here if you're looking to get some higher yields, if you have that extra capital, if you're not kind of weighed down by these interest rates. This is truly going to be a double-edged sword environment. What we're likely to see is, you know, housing continue to correct into 2023, where again, we're waiting for that inflection point where prices come down enough to match basically the interest rate, because obviously if homes were selling at the peak of like 1.2, 1.3, and we get down to 8 or 900,000, guys, the monthly payment will still end up being roughly the same as getting a 2% mortgage on the 1.2 or 1.3 value to compared to a 6% mortgage at an $800,000 value. But this is going to rock the market, and honestly, I think most investors are pivoting pretty dramatically. And one thing I heard is a lot of people, a lot of businesses, they're all flooding into GICs, guaranteed investment certificates here, because these things are basically paying more sustainable yields than anything you're going to buy in the market with zero volatility. These are things that I'm going to be looking to pivot into my portfolio. A lot of you have been asking me about these and why I haven't bought them yet, because you lock them in. And I do not want to lock them in when I know the rates are still going higher. And I think we just saw the last real pivotal rate hike. So I am going to be adjusting my portfolio, taking some cash, perhaps moving some of the individual stock positions I have around to perhaps take advantage of these into the coming beginning of the year, because again, these are rare opportunities that I just don't think are going to last. Now, obviously, I don't expect the Fed or the Canadian Treasury to cut rate hikes like within the next 3 to 6 months, but if we start seeing a deterioration of the market, a deterioration of the work market, which we haven't seen just yet when it comes to the workforce, that's when they will likely start to pivot a bit, and we'll start seeing a leveling off. And as inflation continues to cool, they will likely start to cut those. So you really want to lock these in for long periods, like, I mean, at least 2 to 3 years when you're getting a solid 5%, because again, this isn't going to last forever. This is one of those rare opportunities where if you have the capital to take advantage of it, I highly suggest paying attention to these because it's just a fascinating world out there. And I want to know, are you being hindered by these interest rate hikes? This is why I've advocated zero debt, not taking on these massive mortgages. A lot of people hate me because I've been so cynical about the real estate market here, because I just don't believe it's appropriate for any single person to mortgage $500,700,000 with like $100K down on a property. I've always stated that you shouldn't buy a house unless you have 50% of those assets backed in some other investment. So for instance, if you're taking on a $500,000 mortgage, you better have at least $250,000 to $500,000 in stocks and other investments. But most people just didn't do that. So I'm really curious to see the effects this is going to have on the broader market and the echo it's going to have over the coming months. But I'd love to know what you think in that comment section below.